All right, so the stock market, the end of the year run up that's expected by a lot of people is happening right now. So then options trades, what kind of trades would you put on if you expect the market to be running up in the end of the year? I'll give you 5 that you can think about really quick. The first one is the standard buy calls. Why would you buy calls? Most people hate this strategy. And the reason why is because you can not just buy at the money or out of the money calls, but you could also buy in the money calls. This as a stock replacement strategy. You basically just hold on to them just like you would shares of stock, and you see what happens. You have a stop loss, a minimum risk. In the call itself, you have a downside that's limited to the amount that you paid for the call. But if you don't want to go that far down in the event that something bad happens to the market, then you can have your own stop loss put with the option itself. So in other words, if you paid $10 for a deep in the money call, a 90 delta plus call, you paid $10 for it, you could have a stop loss of say 5 or 3 or whatever you want, and then just otherwise hold on to it through the end of the year. Another trade could be selling a put spread on the same underlying instrument. Now, for most of my trading, I usually use QQQs or SPY or something like that, a broad index, but you can use individual stocks. Anyway, you could sell a 10-point wide or a 5-point wide put spread on any of your favorite stocks or index and see what happens there. Because if it's an at the money or out of the money put spread, then you are long theta. And a lot of people are more comfortable with the long theta trades because they have a higher probability of success. All right, along those lines, trade number 3 would be just to simply sell puts, sell open-ended puts. They could be cash-secured puts or if it's regular put. Now, with this strategy, you can also think about selling an in-the-money put, and the reason why is because you want to capture some of that intrinsic as well as extrinsic value that normally people are going for when they sell at-the-money or out-of-the-money puts. I think the underlying stock or market is going to be going up. You can sell a slightly in-the-money put, maybe an 80 delta or whatever, and see what happens there. You could very well capture both the intrinsic value as well as the extrinsic value of that put. All right, trade number 4 that you can consider is doing a long upside calendar spread, which would be a long call calendar in particular. So you might want to do this one slightly out of the money. If a stock is trading, let's say $60 per share right now, you could do a 62 or 65 call calendar. And what that would do for you is that you would hopefully let the front expiration call expire, reducing the cost of the call in the back month that you want to hold for longer term. Maybe it's in January, maybe it's late December call, it's up to you. But these are particularly beneficial if you can find a differentiation between the front expiration implied volatility and the farther back implied volatility. You're going to be buying the cheaper one in the back and you're going to be selling the more expensive one up front. Usually these kinds of disparities occur around earnings events or something like that, but if you can find one without an earning event, that would work for you too. All right, the next trade on this list is you can sell an iron condor, but instead of just the standard one where you are basically delta neutral, you can make it an upside condor. And by selling a closer to the money put spread, then you do a farther away call spread. So as an example, if the stock was trading for $60 a share, you could sell the 60-55 put spread and also sell the 65-70 call spread to create this iron condor. All right, so all 5 of these trades, of course, have a bullish orientation, and so you should be diversified in your use of all of these strategies, and also you should be diversified in the underlyings that you're using them on.